Good afternoon, everyone, and welcome to today's webinar hosted by the Georgetown Office of Planned Giving and the Georgetown University Alumni Association. Thank you for joining us for Rethinking Wealth Management in the New Normal with Will Finnerty. I'm Mindy Siebenall, the Executive Director of Planned Giving, and I'll be facilitating today's program. Before we get started, I just want to share a few housekeeping items. This webinar is being recorded, and the recording will be made available to you on our YouTube channel within 48 hours of today's broadcast. You'll also receive a link to the recording in our follow-up email. Feel free to send questions throughout the presentation. We'll also leave a couple of minutes at the end for Will to answer any additional questions. Feel free to submit those questions using the questions section of the GoToWebinar control panel. If you're having any technical difficulties, please also submit those via the questions panel, and someone from Georgetown will get in touch with you. It's now my pleasure to introduce Will Finnerty. He earned a finance degree from the McDonough School of Business in 1994 and now leads Finnerty Partners within UBS Private Wealth Management in Washington, D.C. Will manages client relationships and leads all investment consulting, advanced planning, and relationship management efforts. Finnerty Partners works with a select number of ultra high net worth families throughout the U.S. and internationally who have $10 million or more in investable assets. More specifically, their focus is helping entrepreneurs and their families organize, plan, and manage all aspects of their wealth. Will previously taught entrepreneurship at Georgetown and was an adjunct professor for 16 years. He's been recognized nationally as a Barron's top advisor, as well as within UBS as a lecturer on financial advisor development and practice management, and has served on as a member of UBS's financial advisor advisory committee to ensure UBS is a firm of choice for high net worth and ultra high net worth investors and their advisors. Without further delay, I'm pleased to turn things over to Will.
Thank you, Mindy. What a great introduction. Hello, everybody. I'm delighted to be here. I was just laughing with Mindy and Kelly, and thank you, Kelly, for all your help in putting this together. Originally, we were all going to get together in Hong Kong and then in Bermuda, but here we are virtually talking about wealth management in this new normal. I'm reminded that it was just about 26 years ago that I graduated from Georgetown. I was working at the Tombs. I think everybody remembers where that is. I was studying finance, and that led to my career in wealth management. I'm delighted to share my thoughts here today in the short time that we have together. And I want to reinforce to everybody that this is about education. I'm in a highly regulated industry, so anytime we put materials up in any venue, they have to be compliance approved and have all kinds of appropriate wording. You can disregard anything that lines in with that. This is just about helping you all get a grasp of a new way of thinking about wealth management that I hope you'll enjoy. And then hopefully take away from the talk today something that you can use. So as I mentioned, I graduated in '94 in finance, and it was got into wealth management shortly thereafter. And it was about 5 years later, 1999, when for those of you that invested back then, where the stock market was skyrocketing. Back then, wealth management was more idea-based, I like to say, more stockbrokers than advisors. I had this wonderful older client named Janice, and she was tough. I remember her asking me late that year why the guy that cleaned her swimming pool was up 100% in technology stocks and she was only up 50% in a broadly diversified portfolio. So I remember thinking, this is strange. We've got clients that are frustrated that they're only up 50%. Back then, guys, what was happening is many investors were piling into technology and seeing their portfolios grow and their wealth grow significantly, only to have all of that crash shortly thereafter. And what followed after Y2K was 3 years of mounting losses, which ruined many financial plans. And at the core of wealth management is planning, which we'll talk about today. That period of my career and of my life really taught me about following the herd and how dangerous that can be, and why planning is so important to the success of wealth management. Another really important element that I'll touch on in the next few minutes. So flash forward about 10 years, 2008, and now we're in the global financial crisis, which fell upon us. And for those of you that remember that time, even the most diversified portfolios had these massive swings. You could virtually own anything other than cash and treasuries, and it was down. Very scary time. Our whole infrastructure, structural imbalances was kicking in. Stocks were down over 50%, and the whole global financial system was at risk. And so many investors also made some major mistakes in facing those extreme conditions. And so that period for me in my career had reinforced not only the importance of planning, but also risk management, and why actually following a single strategy, which is what's traditionally done in wealth management, a single strategy of wealth management can also carry risks. And we work with families, large families, that don't want large swings in their portfolio. They want consistency, like many of you all. So I'm going to share what we learned from that in just a minute. And of course, now flash forward to the current situation that we're in, guys. All of this volatility is fresh in our minds. This was the fastest correction in history by a really, really large margin. The average correction in financial markets takes about 7 months, and this one took 17 days. So extreme sell-off, to say the least, rapidly declining markets. How do you manage wealth? How do you keep control of your wealth management plan during unprecedented times like that? Well, we're going to show you a strategy today. And by the way, this strategy doesn't belong to me. It's really based in goal-based planning. You can do this on your own or with your advisor. That's really up to you. But at the core of it, what it's doing is it's combining a multi-tiered approach to managing capital in the same way that you think about your money, not necessarily how your advisor may think about your money. It's very common for advisors to pigeonhole clients as conservative or moderate or aggressive, and I think that's a big mistake. So we're going to talk about what's important, and I'd like everybody to think about what's important to them around their wealth management goals. That's going to play a role here in just a second. If I could speak for everybody for just a second, I think, under scrutiny, it's more than just money, right? It's about what you can accomplish with your wealth, expressing your values, supporting the things that you care about, and living a life that you're really proud of. So take notes as we chat here in the next half hour or so. I'm going to rattle off some books that I really like that have had an impact on me. And obviously, we'll save some time at the end for questions. But before I get into the crux of my presentation, I want to just give everybody a sense of what traditional wealth management looks like, in my opinion. If we bumped into each other on an airplane and you asked me what I did for a living, I'd draw these circles on a napkin. Traditional wealth management is the investment part or investment consulting, the planning part that informs the investment part. Advanced planning involves what we call your executive team, which is your tax person and your legal person and your insurance person. And then the service part, like in any industry, you want to have communication with your advisor, or if you're doing it yourself, be clear on your process. So this is what I would argue traditional wealth management looks like. And now I'm going to share with you, given this new normal, how we employ this traditional wealth management in a goal-based format that you all can use as a framework in your own lives or with your own advisors. So going back to that question I just mentioned a minute ago, what's important to you? And I think all of us have thought about this probably more in the last few months than we have in a really long time. This awful virus has reminded all of us how fragile life can be, how important it is to focus on the right things, the right people, the right causes, and what's really important overall in our lives. This is usually the point when I'm in front of people where I ask them to raise their hands and share what they've thought. But I put together a bit of a list for you guys that you may or may not relate to. And even if what I have up here isn't on your mind, I think that it applies to most all of us, that you want to be confident that you can achieve what you want to through your wealth management. Many of us would be happy to achieve one thing. Some of us have more elaborate goals in how we're approaching wealth management and what it means to us, but I don't think anybody says on their deathbed, I just wish I could have beaten the market or the S&P 500. I think wealth management is about serving these larger goals. Georgetown is, in my mind, in my own estate plan, my wife and I, giving back to causes that are important to you or your children or grandchildren. This is about goal-based wealth management. And in this environment, as I map out how we do that, I think intuitively it'll make sense. The big mistake that I'm going to touch on here multiple times is that investors sometimes forget to marry the results that they're looking for with their actual investment plans. So what that means is they have a goal of, say, beating the market, for example, which is a pretty common one. And what they end up doing is taking way more risk than they need to, or not enough risk in order to accomplish those goals. And this is where risk as a function of wealth management is so incredibly important. You know, I've never been to a cocktail party where someone talks about the risk that they took in their portfolio. You know, you never hear someone saying, hey, you know, my standard deviation last year was 12. You know, everybody look at me. You'll often hear people talk about things that worked and they like to spout out returns. I actually get a kick out of that when I'm included in one of those conversations and they say, hey, I did, you know, 10% last year. I'll say, oh, really? What was your alpha? How much risk did you take? And of course, I get very strange looks from my counterparts. But risk is central to wealth management. The best book I've ever read on investments by Howard Marks is called The Most Important Thing. He spends a great deal of time discussing that markets are, in fact, fair and efficient most of the time. They're not always efficient. And this is where clients and investors allow fear and greed and emotions to kick in, and where significant mistakes are made. It's around risk management. And goal-based investing helps shelter you from yourself around this risk management. And I'll show you how in just a second. The analogy that I can give you that I think resonates is if we needed to get from here to the Tombs to have lunch, and we had an hour to get there and we were a mile away, getting on a motorcycle and going 100 miles an hour down Wisconsin Avenue is an unnecessary amount of risk, right? We may get there quicker, right? If we get there in one piece, we got there in a minute rather than an hour. But if we walk and we get there on time and we're safe and we get a little exercise, I would argue that might be a better way of doing it. So this approach of goal-based, which we call Wealthway, my team calls Wealthway, it really involves layering risk in line with your goals and designing a plan that's going to protect you from yourself when we get into these extreme situations. The one that we just lived through here a few months ago, some will say that we're still in the middle of all that, and ones that will occur in the future. They will absolutely take place. So moving away from traditional markets and more towards a focus on you and your goals and what's important. So look, I'm not trying to say that doing well in the financial markets isn't a good thing. Let me make that clear. All of us would love to perform well in financial markets. That's certainly something that should be a part of your wealth management plan. But focusing too much on short-term returns is where you can run into mistakes. And I'll go back to that 1999 example just a minute ago. For those of you that were invested, you'll remember that internet stocks doubled that year. The tech markets in general were through the roof. NASDAQ, which is a very common tech-based index, was up 85%, and the overall market was up significantly in that year. And for anyone that was invested highly in technology, which was a lot of people, because crowds tend to focus on crowds, you went from the best performing sector to the worst performing sector the following year. Literally number one to dead last. So if you owned those kinds of things without risk management, you fell and gave up virtually all of your return the following year. And the challenge with losses, folks, is that you need almost much more than you lost to get back to where you started. If you start with $100 and you lose 50%, you need a 100% return to get back to $100, not 50. If you lose 50 and then you gain 50, you're at 75, not at 100. And so that 1999 example could be used in the 2006 environment. It could be used in the recent environment. Diversification actually helps returns, smooths returns, and reinforces your wealth management goals. Had you had a balanced approach to that, and again, I'm going to show you how you can make money or design your wealth management goals around high returns. But by creating balance systematically in the portfolio, you can actually benefit from highs and lows. Take money off the table when they've gone too far, add to markets when they're low, and not make mistakes. And if you write anything down from my 25 years of learning how this stuff works, the vast majority of mistakes are made in the really, really good times and the really, really bad times. It's often not in the middle, which is most of the time. So when things are clicking along nicely and markets are growing, there's a sense that, look, I don't want to pay someone for this. I put money in the S&P 500 and it grows higher. There's nothing wrong with that, folks. And many of you probably use that type of strategy. Where those kinds of strategies can sometimes run into trouble for some is in those extreme situations where we as human beings become greedy or become fearful. And in those scenarios, it's much harder to figure out what's prudent and the smart moves. And the other challenging thing in those situations, even for advisors like me who have done this for a few decades, good advice often doesn't sound good. That's the problem. It doesn't sound like good advice. It sounds like crazy advice in many situations. I remember an older client years ago that I was encouraging her to remain invested and not to panic and not to make moves. And she sort of grabbed my arm and she said, "Young man, I feel like I'm standing on train tracks and there is a train coming at me and you're telling me to stay on the tracks." I never forgot that. And I'm not making light of the fear that comes from volatility. It is significant. But again, going back to this idea that you focus on yourself and your goals and not so much on the short-term performance of markets should help you make decisions. So that focus from financial markets to you personally is what I'm going to suggest here. From beginning to the middle, to the end, your goals, your beliefs, your values, your passions, all these things play a role in a really solid financial plan. At the end of the day, even though we can talk numbers, and believe me, I do it a lot, and I enjoy talking about performance, none of that means anything in a vacuum. It comes back to, are you able to live the life that you want to live? Do you have the impact that you want to have on your children or your friends or your institutions like Georgetown? Beating the market doesn't mean anything if you're not on track. If you're not able to do the things that you want, put your children or grandchildren through college, make donations to philanthropic causes that mean a lot to you. That's the crux of goal-based investing. And mapping out that game plan is a really, really important part of this working. Now, that goes well beyond what we're going to talk about today. One of my favorite books in just life in general is The 7 Habits of Highly Effective People by Stephen Covey. His habit number 2 was start with the end in mind. Map everything out in your life before you get started. Isolate the things that are important to you and then build towards them. The framework or the blueprint analogy is used quite a bit. And in doing that, as we shift more into how we go about doing this, I'm going to suggest that you think about your wealth, not in the traditional way that we began this conversation, which is I'm a conservative or a moderate or an aggressive investor, and so everything is in this pie chart that graphs over time. But actually, I want you to think about your wealth management goals in three parts, three strategies, actually. And these are terms that I use, but you can call them anything that you'd like. These three strategies are liquidity, longevity, and legacy, and how we operate with the families that we serve. And I'm going to walk you through what each of these does in just a minute. But what this does in developing a plan where you allocate capital into three strategies instead of a single strategy, each with their own separate goals, what it does is it puts the goals at the front and center of the stage instead of some arbitrary goal like beating the market. This type of approach is unique to everyone. It's designed specifically for you, and I'm going to show you how to do it in a second, so you can do it yourselves or bring it to your advisors. And it allows your wealth to work the hardest way possible without exposing you to risks that may hurt your ability to accomplish your goals. Organize your money the way that you think about your money is the way I like to put it. So let's walk through each of these at a very high level. Liquidity is like your rainy day fund. Now, the way that we develop liquidity for families is 4 years of cash flows. 4 years of cash flows. So the balance of the cash, the first year might be liquid that they can use for spending, but the balance is usually in high quality municipal bonds. But this is really, really safe stuff that you're setting aside for a rainy day. Now, I'm going to get to in just a minute towards the end, when you're younger and you don't need 4 years of spending. I totally get that. These piles of money can have different values for different stages of life. But I'm going to give you an example for what, say, a middle-aged investor or family might look like. And then we can dial things up and down in just a moment. So 3-4 years of spending, super high quality, super safe. That's designed for cash flows, and we'll go for it in just a minute. I'll tell you more about what that means. Longevity is what you might call your nest egg. So this is really the core of your wealth management plan. What I like to think is this is where the traditional financial advisor might say, you're a moderate investor. Let's look at your goals. Let's look at what you need to spend over the course of your life. This is designed to provide you with that cash flow over the course of your life. It's typically balanced, stocks and bonds and other things. We manage this pool of money like a pension fund, right? So when you think about what your longevity bucket might look like, it's tied to your life expectancy. It has all kinds of different kinds of investments. It's set to your budget, which is designed by the first part. Oh, and by the way, the other benefit of having liquidity in place is you have to figure out what your budget is. You actually have to figure out what you're spending. That drives liquidity and obviously informs longevity. Now, for those of you that have advisors, there's usually technology you can use to back into what this number should be like. For those of you that do it yourself, you can find calculators online that will help you figure this out. You type in virtually all of your financial information and it will tell you, here's your number based on the level of risk that you want to take and how much you need to set aside in order to fund your long-time life goals. Everything else falls into the third bucket. So legacy is effectively the money that you don't need to live off of, but that you want to grow for what's important. We manage this capital like an endowment. So this has the kinds of higher performing, longer term, less liquid type things. It might include real estate that you own. It might include artwork that you own. It might include private investments that are less liquid and less available to you. We'll talk more about that in just a moment. But when you know you have liquidity and longevity taken care of, you've effectively allocated everything you need to take care of your goals. Everything else is really being managed for someone else, either your children, your grandchildren, your philanthropic needs. So not to get technical here, but when you think about how each of these piles play a role in one's financial life, it tends to be, at least for me and many of the people we work with, how we think about our money. I've got my safe stuff over here. That helps me pay my bills. I've got sort of my stuff that I might need in the near future as I make moves and what I want to do. And then I have the long-term stuff that I know I'm never going to touch, or I hope that not to touch way, way down the road. Managing each of these piles independently with a different mandate towards risk gets you more efficient returns, and it helps avoid making mistakes during really extreme events, good times or bad times. So how do you come up with this game plan? Going back to this idea of putting together a plan. Einstein, I love this quote, was noted as saying that if he had an hour to solve a problem, he'd spend 55 minutes thinking about the questions to ask and just 5 minutes on the actual solution. So what are the questions that you should be asking yourself to begin this process and build out your goal-based plan? Elon Musk just put out that really the really tough things to figure out are which are the right questions to ask. Once you figure out the right questions, the answer is relatively easy. In my practice, we have dozens of questions that we ask for families, but for purposes of this conversation and really just in general, I wanted to offer 5 to you all that you could write down and think about and use as you explore your own personal wealth management. You can see that we have those strategies underlying all of these, but it doesn't really necessarily need to go in any particular order. I like to think personally as I go through this exercise for myself and my wife and our 3 little boys, what do I want to accomplish? And that's one of those questions that are sort of easy to dismiss, but if you really sit down and ask yourself, or you and your spouse, your significant other, what do we want to accomplish? Boy, is that an interesting conversation to have. There's all kinds of great resources that you can use to answer that question. If you've ever built a life plan, this is an incredible exercise. I do it every single year. Just personally, I take time after the holidays or in the middle of them before the year starts to separate myself from my work and my family and really write all these things out. It begins with my own obituary. So if you haven't gone through this exercise, it's incredibly powerful. You actually write out, what you want people to say about you when you're gone, and then it transitions to your 10-year plan, your 5-year plan, and your 1-year plan, and then finally what you're working on. And although it might take some time to work through that exercise, I can read that anytime I want. It takes just a few minutes, and it really reminds me what all this is for. That translates into the second really important question for me, and that is, who are the people that matter to you most? Because when you begin to think about those individuals and how you want to accomplish things in your life, it tends to simplify a lot of the noise. I'm certainly going through that from what we've just gone through here in the last few months. And so I think it's more appropriate than ever. What are your concerns is the third question. This is the big one. We all have them. What keeps you up late at night? Laying those things out and making sure that they're clear not only gets them out of your mind and onto paper, in my opinion, but it also allows you to flush out some of the concerns that maybe we should give a little bit of additional attention to. People tend to blow these things up at times. And look, I've had very serious conversations over the last few months with clients and friends about the nature of where we stand in the world. So far, the worst case scenario seems to be fading, and better case scenarios seem to be gaining some strength. We'll see where this all ends up. But the simple act of writing things out and thinking things through can lend themselves to these larger plans and allow you to focus. How you intend to achieve this, the vision that you've got, that comes down to the brass tacks. Are you working? Are you investing? Are you hiring professionals? Are you doing it yourself? This is really where the rubber meets the road, and getting specific about how you intend to implement some of the stuff that you want to get done. And then your legacy. What do you want to leave behind? These are conversations that can be very important, very deep. much of the work in Georgetown's Office of Plan Giving, they are experts in helping alumni have these conversations and thinking these through. They've been incredibly helpful to me, my wife, and my father, who went to Georgetown, and both my brothers that went to Georgetown, and maybe my kids someday. So the answers to these important questions, guys, are going to inform how you approach your wealth management goals, and should help you populate the organization of the materials that will inform you around how you manage things going forward. The answers are important. They will inform your goals, and then ultimately they will inform these strategies if you choose to pursue something like this in your own wealth management. So one of my favorite questions from my 8-year-old is, how do you eat an elephant? And for those of you that know that one, you might be chuckling. He heard this on the playground. He absolutely loves it. And the answer, of course, is one bite at a time. So going back to liquidity, starting from the beginning, let's talk a little bit more specifically about how these things work. And at the end, if you have additional questions, I'll certainly take those. But liquidity is, again, 2, 4, 3 years. It's just about allocating what you feel you need to spend in the coming years. Now, if you're working and your primary mode of paying bills is going to work, then you could probably dial this back to 6 months. But having cash or access to cash is extremely important in a wealth management plan that's going to hold up through highs and lows. There are 20 million people that would support that right now who are unemployed in the last few months. One of the big mistakes that we see, not only with investors, but even our largest families, these are families that can net worth exceed hundreds of millions of dollars, even billions of dollars, is they have no budget. And the challenge is, or the response is, well, you know, we've got plenty of capital, and so we don't feel that's necessary. The tragedy behind that assumption is that if you have no idea what you need to spend, not only does that mean you probably don't know everything that's being spent, but it's harder to manage risk around a family, no matter what the size. The beginning conversation around managing wealth needs to be your outflows. And if you have income from work, that's fine. If you have Social Security or annuities, or if you have investment properties or investments that pay out, all of that's terrific and should be taken into account when you think about how you're going to manage your wealth management goals. But if you don't know what you're spending month to month before taxes, you need to know that. If that's the only thing that you remember from this call today, please take account of what's going out and what's coming in, because that will lend itself to a more successful plan no matter what you decide to do. The longevity side, this is, for many of us, the bulk of our financial net worth. This is designed to provide that cash flow. And so this can involve travel or buying homes or taxes. Again, if you're working, there may be a combination of the two. So you may say, look, my longevity bucket's growing, but I'm not having to pull from it because I'm adding to it. I'm in an accumulation phase. I'll show you how that looks in just a second. But for those of you that are no longer working or retired, this is your nest egg. This is the thing that's providing you with cash flow. It's got a balance of investments, and of course, it's there to weather the highs and lows. Unlike the first example, where you didn't have a significant net worth to necessarily manage it just yet, one alternative to liquidity is the use of debt. Now, I'm not a big fan of debt. I don't like to borrow for the sake of borrowing. There are situations where I think debt makes sense. For example, a mortgage, especially now, given that there are historic lows. If there's tax deductions, I think that can also make sense. I'm a big believer in a soft pillow. So for many of our clients, just paying off debt and living debt-free is the choice for them. But one of the silver linings to all of what we've just gone through is that interest rates are really, really, really low. They've actually never been lower, ever. And in many countries around the world, they're actually negative. What does that mean? That means in parts of Europe, if you get a mortgage right now, the bank gives you a check every month. Can you imagine that? So you take out a mortgage to buy a house, and then you get a check every month from the bank. Remarkable that interest rates are so low. And the Fed does that in order to get people buying and investing and growing. you should be able to borrow right now incredibly low rates. And so as an alternative to carrying lots of cash, if you're not inclined to want to carry that much liquidity, you may have access to very, very cheap money. That's one alternative to the liquidity strategy. But for purposes of our conversation today, this longevity bucket is year 4, if you have 3 years in liquidity, year 4 and on for the balance of your life. This is where we're using Monte Carlo analytics and planning software. This is all of it. You can get this online. You can do it for free. You can use your advisor. But you should really be using analytics to figure out what that number represents. It's designed from your budget, again. So going back to why liquidity is so important, once you know what you need to spend over the course of your life, that will inform how much you need over the course of the many years. And by having that capital in one place and managed to the appropriate risk level that you have, you'll be able to rebalance the portfolio during moments of crisis. So again, going back over what just happened from us in the last few months, if the market drops 35% in a month, like it just did, and you don't have a liquidity bucket that outlines for spending, you might be tempted to make changes in the portfolio because you'll know you need the money. You have something over the horizon that you need the capital for, and you need to pare back your exposure so that you don't run into trouble. Having liquidity there, knowing that you have access to capital, it lessens the urge to do that. And what it allows you to do is actually take advantage of the portfolio by buying into dips from the other parts of what's safe. So if you have stocks and bonds or gold or any number of alternative asset classes, if stocks drop by 30%, you can sell some of your bonds and buy more stocks. And if they go back up 40%, you can sell some of the stocks and add it to bonds. All of that can be done. That's called rebalancing, without the urgency of having to pay bills, because you have 3 or 4 years of living expenses set aside. And by the way, guess how long on average it takes for a portfolio that's diversified to recover from a significant downturn? About 3 years. About 3 years. So there's a reason why we have liquidity designed the way that we do. We know that if you've got capital like that set aside and we run into a nasty market, whether it be the one we just went through, 2008 or 2001, you have plenty of capital to get through that, and you're less inclined to make mistakes. You're more inclined to benefit from volatility rather than panic. And although crashes are scary, they offer the best opportunities in your financial life. The last 2 months, the stock market's up 40%. You will be hard pressed to find a time in history where the stock market goes up 40% in 2 months. In fact, it doesn't happen. The last 50 days in the equity markets are the best 50 days ever. And so trying to time things to get out or in or out of financial markets is dangerous. And by allocating capital into those buckets, you're avoiding that mistake or minimizing the possibility of it. So legacy is the balance. And for those of you that have the ability to set aside legacy capital, you're later in life or you successfully sold a business, these are the funds that we feel are going to last beyond your lifetime. Many successful families know that there isn't a scenario where they're going to be spending all of their money. In fact, I think all of us agree that if you get to the end and you have nothing in your, maybe that makes you brilliant, but I was gonna say if you have nothing in your accounts, that's not likely to happen. So figuring out what you need, which is liquidity and longevity, allows you to allocate capital to legacy, effectively separating the capital as a separate pool, a separate risk mandate, and looking at these values very closely. Longevity pools, as I mentioned, are managed like pension funds, lots of fixed income based on life expectancy and reviewed annually. Legacy capital is managed like endowments, like the Georgetown Endowment. You use private investments, much higher returns in these kinds of investments. You can employ significant philanthropic strategies. You'll see we've got Georgetown in there. They are a central part of my personal estate plan. My family has been deeply committed to the university for generations. I absolutely love the school and everything it's done for myself, my own personal life, and my family's. But you may have other interests in your own life. We find that many families are less inclined or less motivated to set up philanthropic and estate planning strategies when they're not certain that they don't need the money, which is a perfectly reasonable thing when you're thinking things through. But the other thing that it allows you to do is take risk in the bucket or the strategy where you can afford to take risk. So if you're transferring wealth to future generations, or you're simply trying to get higher rates of return, you can allocate risk to that pile. And so if the markets fall from the sky and that were to lose half of its value, God forbid, it's not going to affect your life in any way, Again, supporting this idea that you can take opportunities instead of making bad decisions in these extreme examples. So no matter where you fall in the spectrum here, and I put just a little glimpse of here of whether you're early stage, later in your career, or you're no longer working, these piles don't necessarily all need to exist. In fact, when you're getting started, you may just have the liquidity bucket. You're just trying to build that framework to work off of. If you're later in your career and you have adult children, or you're trying to accumulate capital, maybe it's a smaller portion of your portfolio. And then if you happen to be in a point in your life where you have significant wealth to manage for your family, you may have more of that capital in legacy. And managing each of these capital pools requires a different level of risk. So when I mentioned earlier that one of the mistakes that we've seen when families approach us is they said, this is the way we've done it up until now, we're balanced. But when we really drill down into what they need, they're not balanced overall. They're super conservative in the money that they need to spend in the near term, and that should be managed well at very low cost and highly liquid. They have tend to have a more moderate balance to the core of their portfolio that's in place to do all the things that they want to do in their lives. And then they've got a pile of money or capital that is probably being managed balanced, even though they have no intention of touching this. And this is capital that will go to their children or their grandchildren. We had a new client recently who had all of their capital in municipal bonds, for example, and they were older and they were conservative. Out of some analytics and going through our process and all our questions, we figured out they needed 32% of their capital. And when we pointed all of that out, we went through the exercise I'm suggesting that you all go through in your own lives. What they realized was the majority of their capital should be managed more for their children or their grandchildren's timeframes, not for their own. They got more excited about estate planning strategies that they wanted to embark upon, guideposts that they wanted to get done in their respective areas. And that opened up their framework to a much more usable, more identifiable wealth management strategy that helps them make better decisions as they cycle through the coming years. So again, I would ignore the wealth way part up at the front or the top of the slide for just a minute. I'm just going to circle back to where we began the conversation. And that is this idea that having a goal-based approach where you've got your game plan, your blueprint, you've got a more specific approach to managing risk and how you approach these various capitals. It can boost your confidence that you've got a portfolio that will weather any storm. It's helpful in taking out emotions out of investing. We're all human beings. We all make emotional decisions. I don't care who you are. And so designing a platform that helps you or protects you from yourself, depending upon how you look at it, should encourage better returns and a softer pillow at night. We actually present the performance of those three strategies separately when we're sitting down with families. So I'd encourage you to design it in that way. If you're going to adopt anything that you've learned today, think about preparing those capital strategies separately and thinking about how they're working over time. And really embarking on this process with the end in mind. I think you'll find that if you take on an approach like this, it's more intuitive into how you think. It will help you coming out of extreme situations that we've been in just recently, avoid making major mistakes, and it'll give you some peace of mind on what you want to do in the future and how to allocate capital accordingly. So that is the sort of the bulk of my comments, guys. Mindy, I was going to turn it back over to you or to Kelly, and I'm delighted to take questions if there are any.
So, well, we have a couple of questions. The first one is, are you advocating getting a mortgage when purchasing a new property, even if you are perfectly capable of paying in cash, given that we're not in Europe?
That's an awesome question. This is the way I would respond to that. If you don't like debt, don't get a mortgage because I think financially it's a smart decision, but it doesn't have to necessarily be a good financial decision for it to weigh on you mentally. And most homes are owned outright, believe it or not. So really the math, if you're open to the idea, comes down to this. If I'm going to pull capital out of my accounts and I'm going to put it into a home, what I want to know, and borrow money from a bank, the question is going to be really, can I do better with my investments than with the interest I'm going to pay from the bank? Meaning, if I take $500,000 out of my portfolio to buy a property, but I could borrow that $500,000 and keep my money invested, I better make a better return on my investments than the interest rate that I'm paying, or it doesn't make any sense. So right now, because interest rates have never, ever been lower in history, you can borrow money really inexpensively. 30-year mortgages, I think, are in the 3s, 10 and 15-year mortgages are in the 2s. So you have to ask yourself, do I think I can do better than 2 or 3% with my investments? If you're a conservative client, I wouldn't say that's a no-brainer. Don't take the debt. But if you're a growth-oriented investor and you think you can 5 or 6 or 7%, then I think it is a prudent move. And keep in mind, up to about $750,000, the interest that you're paying from a bank is deductible. So if you're paying 2% for a mortgage or 3% for a mortgage, you actually get half of that back. So you're really only paying one something. So that's where it gets tempting. And in the grand scheme of things, I think there's a lot of justification where the math is coming from. But if it gives you pause, or you're nervous about debt, I say buy the house outright. Don't stick a mortgage on there. Just be comfortable, and your game plan should support that.
Great. So next question, Will, is for young alumni, in what stage of life should they start looking for a wealth advisor?
That's a really good question. The nature of financial advice is so prevalent now. I'm a big believer, if you're just getting started, that being an educated investor is going to make you a much better investor over time, even if you choose to hire an advisor. Advisors need to be paid, and fees take away from returns. So for me personally, I wanted to do it myself. I wanted to learn about how this stuff worked. I wanted to arm myself with an understanding of financial markets. I'm obviously in this line of work as well, but I don't manage my own money. I turn it over to professionals to do it for me, because I'm subject to the same kinds of things that everybody is subject to. What I think you'll find as a personal barometer or litmus test, and this often comes up in meetings when we meet someone that's never had an advisor, is there's probably a dollar amount you get to where you say to yourself, all right, if I screw this up, this is going to be a significant amount of money. I'd rather have a throat to choke. I'd rather have someone I can lean on or point to for accountability. Obviously, that's an industry that I now live within. So I think it's really a personal decision. I don't think there's ever going to be anybody that cares as much about your money as you do, no matter how important you are to your advisor. But I think it begins with an education, and I would buy that book I mentioned. The most important thing, Howard Marks. It is excellent, and it's an easy read. It is not highly technical. Anybody can read it. Howard Marks is one of the most incredible investors of the last 50 years. Warren Buffett reads his quarterly newsletter before he reads anything. his books are very well written, and I think you'll enjoy it, which is really what's more important here.
Okay. Next question. Today in the New York Times, there's an opinion piece proposing higher inheritance taxes on legacies from the baby boomer generation to their children. Do you see this as a likely coming regulatory change? And if so, what can be done by the average upper middle class person to ensure they can pass on lifelong savings to their children and grandchildren?
Yeah, that's a great question. Now, I'm not an attorney, so well, first of all, I'm not allowed to give out legal advice, but I do have an opinion. The estate tax was put in place over 100 years ago to pay for World War I believe. That's right. An historian on the call might be more accurate. But who knew that it would turn into such a massive transfer of wealth? Any great estate planning attorney or wealth advisor can help you navigate that process. You can't get away from paying taxes. What you can do is you can use strategies to minimize or eliminate them and replace capital to your family members. And it's very straightforward. It's not smoke and mirrors. This is where insurance can play a role. I don't sell insurance. I'm licensed. I understand it. I see a lot of these policies, but we defer to outside professionals and firms to deploy insurance needs for our clients. Whether or not there is an increased estate tax, it's certainly possible if the Democrats swing the House and Senate and get the presidency. You may recall there was a Trump trade here in 2016 where markets rallied, given they felt that taxes would come down and all kinds of things would happen. We're in the middle of that, right? Anything can happen between now and November, but that's clearly going to capture a lot of headlines. So the good news is you can solve that problem with or without estate planning, or with or without that tax. But if it goes up, and it could go up if the Democrats sweep, not many Americans suffer from that. So I think last year 15,000 families paid that tax. It's a large sum of money to the families that are affected, but it doesn't represent enough of the majority, I think, to get enough people in a democracy to go against it. So, I honestly don't know one way or the other, but I will tell you it's far more likely that it would kick in if the Democrats took the presidency and House and Senate. But you can solve that problem, and that's the good news.
Adding to that, well, I mean, this is Mindy from the Office of Planned Giving. I think we are, there's a lot of speculation about what the exemption amount will be in coming years. Right now, I think it's at almost $22.5 million for a couple, which, like Will mentioned, is a threshold that most people won't meet. So what we think may happen in the future, or could happen, is that exemption amount will come down. I think prior to it going to 22, it was around 10 or 11. And that those tax changes at the end of 2017 pushed it up to the 22. So we would envision that there may be some movement there, and that exemption amount would come down, but you'll want to go talk to your attorneys in terms of if those changes happen, how to kind of adjust your estate plans for that.
Maybe that's a great.
And so next question is, what are your thoughts on rebalancing retirement plan assets when the U.S. stock market feels to be at the top? Follow a set plan, push back moves for a way, or start to move forward toward international stocks for a while?
Yeah, that's a great one. So it depends on how old you are, right? If you're 25, rebalancing can be helpful. It's not necessary, given how long you've got ahead of you. If you're more balanced and you're a little older, statistically rebalancing once a year is the best return, just in terms of modeling. But as long as you're rebalancing something, then you're going to benefit from highs and lows. Although financial markets seem high in the near term, I will tell you, if you look out 5 or 10 or 20 years, what's happening 1 month to the next may or may not. You may not even remember where markets are. And this goes back to this idea of placing capital and managing capital based on the time horizon that you have in play. I personally rebalance my portfolio annually, although we make tactical changes month to month, just the nature of what we do in my line of work. But the run-up in equities, as extreme as it's been here recently, is really tied to the ongoing news that continues to be more positive than negative. And all of the tragedy that took place at the end of March and then throughout the second quarter, as news began to play out on headlines, it was terrible and will continue to be terrible, but it's less terrible than people thought. And so what seems to be happening here in the financial markets, given valuations and given where equities are trading, is that markets are choosing to look through the abyss at where we're going to end up down the road, 6 months to a year. And when you look at trillions of dollars of stimulus that's getting pumped into the US, Europe, and Asia, what markets are effectively pricing for is that we already know the news is going to be awful. We also know that all the stimulus is going to kick in. We know that we'll have a vaccine of some kind, say in a year. Why would I sell off in the short term, knowing that I just can go back as this capital gets put to work? And whether they're right or not, it remains to be seen, right? We try to stay out of the short term, betting what's going to happen month to month, because it's impossible. And we stick to our game plan where we're allocating risk to the piles of money or the strategies that benefit from it. If you're not going to touch your retirement plan for 25 years, whether the market goes down next month or next quarter isn't going to affect your returns long term in major ways.
Okay, so next question. Do you recommend contributing to a retirement account on pre-tax or on a Roth basis?
Okay, it's a great question. These are great questions. Always contribute to your retirement plan, no matter how old you are, and especially if you're a part of a program where they match, because you get a 100% return on that money the second that it hits the account, not to mention the benefits of allocating capital without paying taxes. If you're in a position where your income supports your lifestyle, my general sense is you want to spend 70% and save 30% of your paycheck. Spend 70, create your lifestyle around 70, allocate the other 30 for savings or tithing or philanthropic needs if that's something that you intend to do. But if you're able to live off of the 70% of your paycheck and allocate to the Roth and you're young, that is the best way to grow your retirement capital. So I personally contribute to the Roth 401k plan, right? So I live within my means, and that allows me to push more money after taxes into this vehicle that will grow tax-free and that I can distribute tax-free. And if I manage my own personal wealth plan properly, and I'm able to save appropriately and build my longevity and my liquidity buckets appropriately, then I won't have any reason to touch my IRAs down the road. And that'll allow me to stretch those IRAs for my children or grandchildren, or for Georgetown, depending upon where I am at that point in my life, and benefit further from tax advantages. So the most beneficial version of an IRA or 401k plan is the after-tax Roth, but all of them are good, and it really just comes down to cash flow.
Okay, so that I think we are almost out of time. I just wanted to add a couple of closing remarks. Obviously, thank you, Will, for sharing your expertise with our Georgetown community. And thank you, everyone, for joining us and taking part in the program. We're in the process of revising our estate planning guide, which is a free resource we hope to be helpful in organizing your long-term planning. Please look for our follow-up email, which will include a survey, as well as a link to today's recording. That survey will have the option to request an estate planning guide, or if you'd like a copy of the slides, please just provide your name and your email address. And if you have any questions about today's material, feel free to reach out to the Office of Planned Giving, and our contact information will be in that follow-up email. Thank you all again for joining us, and we hope you have a good day.